there, traders and investors, and welcome back to the Trading Analysis YouTube channel. I'm Bennett. A lot's happened since we last met in October, looking at the possibility of a 1-2 upside breakout in the Nasdaq 100 as well as the S&P 500. We also took a look at the upside expected move in crude oil. Crude oil viewing an 85 area resistance, expecting consolidation into the 79 handle prior to retesting 85. We'll take a look at that in just a minute. We also have been discussing and looked at in the last video update upside expectations in the US dollar. And while we were about a week off on calling the orange wave 4 low, the upside move to 95 has delivered. We'll take a look at how that factors in to our end of year market plans in just a bit. And then, of course, we also discussed the expectations in the US dollar, talking about a 1.67 to 1.75% upside objective. That has also been met. So let's jump on into it. We'll first start it off in the Nasdaq 100. And when we last met, we discussed the validity of viewing the wave 2 pullback as occurring between October 7th and October 12th. Really at the end of the session, and for those of you who happen to follow our Wednesday live stream show, I had a good session discussing this particular topic. But really at the end of the session, at the end of the day, while we do feel viewing this as a sideways flat progression is the most appropriate way to label and decompose price action, we feel it's more appropriate to utilize the entirety of the October 4th through October 7th rally when determining your upside fib projections. And in fact, as you can see here in the Nasdaq, we essentially blew through the previous September area highs. So we had been watching an upside zone of resistance, gosh, going back 6 or 8 months in the Nasdaq 100, expecting 15.5 to 15.7 to yield a corrective pullback. What ended up happening, and as we discussed based on the title of last video, 5 up, 3 down, rinse and repeat, the corrective pullback into the October low proved to be just that, corrective, and not trend establishing, starting a bear market or a larger market correction. This ultimately proved to pair up to the wave 2 counterpart. And from here, from the October lows and the wave 2 low that we discussed, we've seen a move up in wave 3 to the 261.8% 3v1 fib projection. We've seen a wave 4 corrective pullback that may be over. And now we are looking at upside into essentially the Thanksgiving holiday. Now, while I continue to remain bullish longer term in the markets, and I do expect whatever corrective pullbacks that occur as a result of either technical resistance or unexpected pace of inflation, yielding a more aggressive rate hike path. We all know we had the recent, quote, dovish tapering beginning by the Fed. We'll talk about that in just a minute as well. But whatever the catalyst proves to be that yields the corrective pullback, we're going to be viewing those as longer-term entry opportunities because we're bullish in the higher degree trends. We continue to be bullish human progress, and really at the end of the day, Elliott wave is a measurement of growth, human growth and progress. So here we are looking at the 1 hour chart in the Nasdaq 100. I just mentioned blue wave 4 might be over. However, if this proves to be the case, we should know soon because the move off the high can be counted as either 3 or 5 waves, which means this could simply be a B wave and we meander further to the downside in wave 4. Thus far, the wave 4 fib support cluster of equality to 2 has been met. But again, the 38% retracement is down here at 15,734, which would essentially call for a back test of the previous September area high. That's not out of the question. We could very well see that. A bit of a defensive tape today, Monday the 15th. So the idea that this is a B wave, we get a C wave down to that support and then go up to channel resistance again is just as likely as viewing it as a completed wave 4 correction. Okay, both of them are valid interpretations. Now, that's the Nasdaq 100. We do see two very distinct possibilities going into the remainder of the year. Likely, what this proves to be when we meet resistance into the end of November, we're looking for, and as you can see here, we have this chart already labeled with it being just a B wave pullback. But what will likely end up happening is, whether this is 4 or this is in fact that 2, we're looking for markets to find resistance. And I'm just kind of going to back you out to the daily chart here for a minute. We're looking for markets to find resistance into the end of November, enter a larger pullback that could take you to, maybe mid-December, and then we expect seasonal continuation to carry us in through the new year. It's the end of Q1 that I expect the likely larger correction to occur that would exceed anything that we've seen from the COVID low. And there's a couple of things that are kind of stacking up in our favor for that market correction, which we're going to talk about right now. First of all, the chart that we need to look at first is the S&P. And here in the S&P 500, we're tracking a very similar progression in terms of price action from the October area low. Let's drop the circle, get off the daily, drop you down to the 1-hour time frame, and talk about where we are. So from the October low, and here we have it labeled as a sideways flat progression, we're looking at this as either wave 3 or wave 2. More likely this is simply wave 4. Okay, and wave 4 here can be complete. Wave 4 can also take you back down to revisit support before we see the upside into the remainder of November. From the completion of wave 1 and the pullback in wave 2 that we just talked about into December, we then expect a breakout in wave 3 into next year. Now over to the Russell 2000 to illustrate my expectation of a end of Q1 market correction. Over to the Russell 2000, you can see here we've seen a wave progression that has a much higher conviction than the S&P. And what I mean by that is in the actual wave count, identifying the higher degree structures and labeling them with conviction that is in fact the wave count. In the S&P and the Nasdaq, the wave count from the COVID low is a bit more subjective. There are multiple possibilities, and as a result, it makes identifying a potential larger market correction a bit more difficult to do. Here in the Russell 2000, we feel our options are significantly more limited in terms of where price action currently exists. And what we expect here in the Russell 2000, and in fact, we talked about this earlier in the year, the sideways consolidation in effect from February, essentially now just breaking out from the sideways consolidation channel, but really the consolidation concluding back in July with the wave 4 correction. We feel in the Russell, we are absolutely post wave 4 in a wave 5 move, meaning this is 1, 2, 3, 4, and we're in wave 5. You could also place wave 1 in the August high and look at wave 2 as a bit more directional. If you do that, wave 4 concludes at exact price equality to its wave 2 counterpart. But regardless, what this suggests is the idea that we've got a few more corrections and a few more upside moves here before maybe, let's call it March, April, May, June, somewhere end of Q1, maybe end of Q2, this 5-wave trend comes to completion, and we do see a larger market correction to the downside. This is the Russell 2000. Let's look at S&P Midcap 400 chart, MDY. Here in the MDY, we've got a very similar progression where we feel we are post wave 4, and we're going to expect continuation into next year, and then look for a larger market correction. Now, remember, we continue to see the higher degrees of trend as still well intact. So would I, as a result of expecting this market correction next year, look to either 1, scale back my investments, or 2, completely sit on the sidelines in cash and try to sidestep it? Absolutely not. Absolutely not. I would not, if it were me at least, consider doing that, simply because of the fact that we are in such a unique environment and situation. The pressures that the market faces are a result of the supply chain constraints surrounding COVID, and there's many compounding factors, but where it goes from here is very much so unwritten. And therefore, the idea that we, in fact, do see tapering subside and remain at a pace that is, in line with Fed's tapering, bond purchase tapering plans, and rate hike plans for next year. If all of that can be unwinded or unwound, if you would, appropriately, then we could absolutely continue to melt higher and see more subdivisions. But in the meantime, we're just going to continue to stick with the hard right edge of the chart, look for the corrective three-wave trends to the downside as buying opportunities until we're presented with a really good reason to go against this market. Okay, so that's S&P, the Russell 2000 and mid-cap 400 charts. How this would look in the S&P would essentially put us here in either, whether this is orange 4 complete or orange 4's got another move down, or this is even green 2, it doesn't really matter. Ultimately, this would call for end of Q1-ish time frame based on our fib time projections to give us a corrective wave 2 pullback. Now, let me show you the weekly chart. Because here in the weekly chart of the S&P 500, I want you to take note of the fact that from the credit crisis lows back in March of 2009, our orange primary degree wave 2 corrections have been fairly minimal in terms of magnitude. 9% correction there, 10% correction here. Even the higher degree correction peak to trough was 16.9 into the orthodox low, and then 11% at completion. The orange degree, 15%. Okay, so let's go back to our daily chart here. And let's say we move up to our 5,400 area objective, and we see a 10% or 15% market correction. You're basically going to take yourself back to current price levels. Could a larger wave 2 materialize? Sure. But in the meantime, we do not have we don't have the picture painted to suggest that orange wave 2 is going to be a massive move to the downside. In fact, we have evidence to suggest quite the contrary, looking at discretionary, looking at semiconductors, looking at the expected growth, rate of growth in the digital infrastructures that currently exist. So looking to sidestep it a little bit difficult to do. Okay, so that's where we stand, and that's just kind of our big picture overview. Now, let's take a minute and discuss what's happened since we had our Fed meeting, our November Fed meeting. And then we'll take a look at the dollar, crude oil, and 10-year yield charts. So going back to our Fed meeting, when Fed Chair Jerome Powell outlined the bond tapering plans, it was done so in a way that did not communicate urgency on the rate hike path, meaning he did not outline or seem concerned that the Fed would be forced to expedite the current plans for rate hikes into next year, 2022 and 2023. What happened is, looking at CME Group's countdown to the Fed tool, which you can see the probabilities of a hike or a Fed move based on the different meeting dates. Going out to March of next year, the March 16th meeting, you'll notice here the current target rate of 0 to a quarter, the chance of it moving to a quarter to a half before the meeting was like 11.8%. As a result of the meeting, it dropped to around 9.8%. That was the first week of November. November 8th, it was this particular data was sourced from. So kind of a dovish start to the taper. if you would, probabilities of a hike, a quarter point hike at the March meeting went down from 11.8 to 9.8. Then we had last week's consumer price index report. And looking at CPI, while inflation continues to remain predominantly in areas we've seen before, we had some fairly decent and significant upticks. When we got the report an hour before the market opened, we saw gold futures start a rally. We saw gold futures rally to the tune of, up to a high, I should say, of 1870. Had to move up to 1870. Let's see, when was that? That was out on the 10th. Is that correct? Yeah, that was out on the 10th. So let's see if here we are. Back to the 10th. So here is when the report posted. You can see a very sizable rally in gold. Gold often utilized and acts as an inflation hedge. Interestingly enough, we have been looking at price action in gold as essentially in a period of sideways consolidation, higher lows, lower highs, Elliott wave triangle, if you would. And the move up here, we feel, is probably a bit premature, and that this is just D of our wave 4 triangle. But regardless, the CPI report ignited a rally in gold. And we also saw simultaneously the probability of a rate hike at the March meeting go up from the 9.8 that it was to the 18.9% November 12th, now 20%. So 1 in 5 shot, we see a quarter point hike in March. Another metric and gauge that we've been watching are the break-even inflation rates. Back in May, we had a high of 2.51% for the 10-year break-even inflation rate. We broke through that in October. Backtest consolidate November 1. You'll see there's a gap here because Thursday was Veterans Day. Happy Veterans Day to any and all veterans tuning in. We greatly appreciate your service. But as a result of Veterans Day, the bond market was closed. Yields aren't moving. We don't have a read for Thursday. So I think that's why they're missing the line here for the continuation into the Friday's print. Friday, 2.73%. 5-year, same thing. Wednesday, 3%. Friday, a 3.11% move. So there are some concerns, but they're not so much so that we would be defensive or looking to avoid this market. This market is relentless. It continues to climb the wall of worry. Okay. Now, before discussing my alternate end-of-year scenario to wrap up the video, let me take you into oil, dollar, and yields. First up, 10-year yields. Taking a look at 10-year yields, we talked about back on October 19th the idea that we were going to break to 167. 1.67 was met. This is one of the key signs, one of the key 1-hour charts that I am watching across the market. The 10-year yield did a 3-wave, essentially measured move decline. You'll notice the low was just beyond equality of our C compared to A. This is just a Fibonacci measurement of the initial decline, projecting it from your retracement. But what we know in the world of Elliott is that 3-wave move lows here and 3-wave moves in general are counter trend, meaning they go against the higher degree of trend. The higher degree of trend in this instance now still being to the upside. 10-year yields are a key watch. This is something that we feel could give us a corrective pullback as we see the indexes finish the upside move, and then perhaps we could move up north of fib projection resistance and meet 2%. It's not out of the realm of possibilities. Another chart that I mentioned last time that we're watching together and with our clients, of course, would be the chart of crude oil and the US dollar. Let's quickly jump over there, and then we'll go from, we'll go to the alternate end of year discussion. When we met on the 19th, I had an orange wave 4 anchored here. What ultimately ended up happening is the wave 4 morphed just a little bit, and we went barely below that level that I had it anchored at before. We've since broken higher, impulsively corrected in a flat, and we're now 5 waves up into the 1618. Our 95 objective has been met. We'd like to see the dollar meet some resistance here and back off soon. If not, we can at least look to consider a far-fetched alternate possibility that this is wave A and B, or 1 and 2 of a larger upside move for the dollar. Over to crude oil. Here's the chart of crude oil we talked about last time, expecting 85, correction to 97, breakout to the upside. It's exactly what we feel is still at work. We're looking for continuation up to 87 to 90, not out of the realm of possibilities. What we think actually happened here is that, in fact, our orange wave 4 pairing up to the sideways flat concluded on November 4th at the 38% retracement. All right, so that's pretty much it. And now let me take you back over to the S&P 500 chart here and talk about end of year alternate scenarios. And we're going to use the Nasdaq to illustrate this possibility. So down here on the 1 hour time frame, we just talked about the idea that orange wave 4 is complete, or that maybe we revisit down here at 15,715. That essentially backtests this previous September area high. Not much interaction there. From here, we would expect to move into the end of the month and early December. The alternate end of year scenario would suggest that, given the fact markets are up fairly significantly year to date, let's take a look at a percent change from right here, January 1st of January to the current trading levels, the closing high or the closing price today in the Nasdaq. That's a 26.4% move to the upside. So year to date, the Nasdaq 100 is still up 26.4%. The alternate end of year scenario would say that a move back down to the wave 4 low, meaning December could be a distribution month and risk off. Even if this proves to be the case, this is my alternate end of year possibility. Even if that proves to be the case, the markets would close then up still about 12% to 14% for the year, depending on where that wave 4 actually completes. Again, this is an alternate back of the pocket end of year scenario that we are watching with our clients. The way we're looking to determine if in fact that's the case is to look what happens when we meet the next upside move, if we get it, and then gauge the structure of the retracement from the high. We're going to be looking to get very, very aggressive with our trading, our personal trades that we send out to all of our clients into year's end. So if you're interested in checking that out, we would encourage you guys to give us a test drive, tradinganalysis.com. We would certainly appreciate it. See what we have to offer. Okay, so that's about it. The last request is, of course, gold, and this fits quite nicely into my end of Q1, beginning of Q2 market correction concept or projection based on my wave count. Here we are looking at the chart, the weekly chart, I should say, of gold going back to the November low. From the November low, I'm viewing this as up in orange 1, down in orange 2, up in blue 1, down in blue 2, 5 waves of blue 3, meeting between a 1618 and 200% projection of wave 1, wave 4 equal to 2, and a 38% retracement. Wave 5 concluded into the higher degrees between 200 and 2618. Notice our base channel sourced from November of 15, drawn through August of 18, projected over July of 16. That is where our initial August of 19 resistance came into play. You can see the interaction with the upper boundaries of this base channel back in 2019. From there, you'll notice the break higher into August of 20, being met with a three-wave decline concluding in March. You'll notice the lower boundary of this parallel base channel is where price action has found support and entered sideways prolonged consolidation. From the weekly to the daily chart, here's the break higher that we currently have at work. We're proposing that this is perhaps only D of wave 4 triangle. We get E of the wave 4 triangle taking us out to March or April of next year. Then we see the larger market correction in the equity market, and we see perhaps wave 5 to the upside in gold. So that's all I have for you all tonight. I hope you enjoyed the video. If you did, please give it a thumbs up and subscribe with notifications. It lets the YouTube algorithm know that you do enjoy the content, and it helps to distribute it accordingly. Thank you all again so very much. We appreciate you tuning in. We'll be back. Don't forget to check us out every Wednesday right here on the Trading Analysis YouTube channel, 8:45 Eastern, for the TA Live Wednesday live stream show. Thursday mornings, 9 a.m. Eastern, right here on the Trading Analysis YouTube channel as well for Crypto Lab with Alex. Check us out anytime, tradinganalysis.com. Take care, and I'll see you on the next update.